One thing I never understood being in the lending business for 22 years was how consumers never really had immediate access to their credit reports. More importantly, how they really didn't understand how they worked, the good, the bad, and how they got to where they were. That's what I want to talk about in today's episode. I hope you guys enjoy. Welcome back to the What's More podcast. I'm your host, Quentin Harris. I get asked all the time about credit, questions on it, how to improve it. More importantly, what does it mean? How did we get to these models and what derives my credit score? So we're going to take a couple of episodes. And in this one in particular, I kind of want to talk about credit, what it means, the definition of it, defining all the models, and then the impacts of your credit score. And then later, I'm going to talk about some hacks to help you improve that. So let's go ahead and start with a couple things on credit. When we talk about credit, we're referring to the three major repositories. You probably have heard of them: Experian, Equifax, TransUnion. And I think it's really important that we kind of understand that all three of those repositories are what are traditionally used in today's credit environment. Now, I know I did an episode a while back talking about different versions of those coming out in the Vantage scoring model. And while that is out there, it's not as widely adopted as these three traditional models. These reports report all the consumer's ability to essentially pay back debt on a mutually agreed upon time frame between the creditor. They also report many different things from your birth date, your time on the job, what type of job you've had, your residential housing history, your rent housing history. There's a lot of things that go into this credit report, but there's different versions of these credit reports that are out there. And so I want to talk about those versions of the credit reports, and then I want to talk about some terminologies that we're going to use. And when I talk about credit, there's really three types of things that show up on the credit report that most people are going to look at. The first one is going to be a mortgage, and then your installment loans, which are like your auto loans or student debt, and then revolving. And revolving is anything credit card that doesn't have a term. It's an open-ended line of credit versus a closed-ended line of credit. So that also could be your home equity lines as well. So I'm going to talk a little bit about those, and then I want to define some terms that kind of are what we call negative terms on a credit report. You'll hear me say things like late payment. And when I say a late payment, that means you were 30 days late on something. So your credit card might have been due on the 15th, and you end up paying it on the 16th of the following month. That would be a late payment. 60 days would be 61 days beyond the pay date, 91 days beyond the pay date. You kind of get the point. And sometimes you have things that are rolling lates as well. We'll talk about that. Collections, talk about all types of collections and why those are negatively impacting your credit. Judgments as well, repossessions, settlements where you've settled a bill down, you're paying less than what you owe. That could also be called a short sale if you're talking about a mortgage. And then foreclosures, right? These are all the bad words when it comes to credit that can negatively impact your credit. And so as I get into some of this conversation, you're going to hear me use some of those terms. I just kind of want to define them for you and put them out there. So if you're listening to this, you might say, hey, Quentin, I know exactly what my credit score is. I use Credit Karma. I use MyFICO. I use, annualcreditreport.com. I go to Experian.com. I go to one of those places you said, or even TransUnion.com. And they do have consumer-facing credit reports on there. So I think that's probably one of the major differences when we talk to consumers, and there's score variations. We get asked that all the time. Why does my Credit Karma say I have a 720, but then when my mortgage lender pulls credit or the auto lender pulls credit, it's a 702? And that's because those scores are not equal to one another. For example, that Credit Karma is taking a snapshot of what your credit is based on your active trade lines, but not the historical history of your credit report. And I think that also it may not be catching it the same day in which your lender pulled it. And I think something that's really important here when we take a look at this, if you take a look at, like Credit Karma, for example, I think that the way they pull that scoring model is they're using that Vantage 4.0 that I did a whole podcast on versus the Fair Isaac versus the Beacon scores, and also the Experian repository that we're talking about. Those are all going to show up at different times, and they're going to be different models. So unfortunately, different models are not always going to be equal in scoring. And I think that that's really important, because I think sometimes we get hung up on what exactly our score is based on that. And I know if you're using like a Chase credit card, Discover, American Express, they also check your credit and they give you a snapshot of what your credit is. They call it like a credit journey, something of that nature. Those are going to be more in the lines of like a Credit Karma or a MyFICO type deal credit score versus what a mortgage lender is going to pull. Now, another thing to take a look about on credit here that I wanted to share is that when you're applying for any type of loan, there's multiple types of credit pulls. We've talked about this on previous podcasts, but like an M1 credit report, that is going to be a mortgage related pull versus an I1 or an I9 credit report, because that's going to be actually the installment being pulled on there, the installment portion of a credit alert versus a mortgage credit alert. And then you have an R1 credit report, which is for revolving. And so there's different types of reports that lenders can pull. For example, if a mortgage lender is doing a tri-merge, that means they're pulling all three credit reports. Sometimes if you're doing an auto loan, they'll only pull a single merge. And then sometimes if you're doing, maybe it's insurance, maybe it's auto insurance, there might be a bi-merge there where they're pulling two different bureaus and not just all three or one. And they'll take the middle of the three scores. And that is actually how your loan and your actual product and your interest rate is all going to be determined around that particular score. Again, on the auto side of things, it's probably going to be a one single pull, the one that their underwriter prefers. And sometimes on the insurance side, it's more than one, just to kind of make sure they can offset the other score. Maybe there's just things that don't show up on one bureau that may show up on another, because that does happen from time to time. And so when you're taking a look at these things, I think one of the questions we get asked a lot by consumers is, hey, listen, how do I improve my score? Or why is my score, lower than what I saw? Or why are you showing maybe a medical collection and I don't see that? Or why on earth is this, this balance higher over here on this credit card than what I'm showing on my, creditkarma.com? Again, I want to go back to when a lender pulls your credit, they are getting a real-time live snapshot in depth of what's going on with your financial profile. Credit Karma is not necessarily going to do that on a weekly or monthly basis. They're going to take a look at it as their system does a push-pull and updates. And as we've talked about in numerous podcasts, not every lender is going to report to all three repositories at the same time, which could actually positively impact your score or negatively impact your score, depending on what your credit utilization is. So that is sometimes why we get different scores in those models. So let's take it, kind of try to make it more sense here. So let's say you have a MacBook, and the MacBook that you're using is from 2015. And then let's say you have a MacBook 2020 model, a MacBook Air or Mac Air, whatever it's called. The MacBook and the Mac Air are two different models. While they perform the same functionalities, they don't look the same. And one is lighter than the other, and one has higher performance than the other, but it's also maybe more expensive, and therefore it's not as widely adapted yet. It's going to get there. So fast forward to 2023. Now the Mac Air is everywhere. A lot of people prefer it and they use it. I think it's one of their best-selling laptops. And the MacBook Pro is now more of like a higher-end laptop that they've had to readapt and make better so that they could, get more people to use it. But it took time for that Air to become widely adapted. That might not be the best scenario, but that's the one that I got because I'm looking at a MacBook right now. That's the one I came up with. So there are 5 what I consider to be critical components that create your score of how it's determined. This is kind of pulling the curtain back from the industry right now. And this is from our friends over at Partners Credit. And Partners Credit is like many vendors who essentially they provide the credit report to people, and they're the liaison between Experian, TransUnion, and Equifax. As a consumer, you and I, we just can't walk up to Experian, TransUnion, Equifax, make a phone call and go, hey, what's my credit score? We actually have to go to someone that's authorized to pull that credit and then tell us what that is. And, for many years, people couldn't even tell you what your score was when they pull your score. That was one of the most annoying things. Like, hey, we just pulled your credit. Oh, cool. What's my score? I can't tell you that. Like, that literally is how things used to go down. And then obviously there were laws that transitioned in 2010 that now 2008 that required lenders to now divulge your credit score to you and tell you what it is at the beginning of the process, not necessarily at the very end if you were denied. They have to tell you up front. And that was a great move that was changed in the lending industry. But no one still knows to this day, like, how is my score comprised? Like, what makes my score? So your score is simple as this, and this is straight from Partners. I think this is wonderful, is that your score is determined by 5 factors of differing importance, right? So 35% of your credit score is based on your payment history. That's basically, are you making your payments on time, and are you paying your loan in the mutually agreed upon time frame? Pretty simple. Late payments, that's going to hurt your score, right? 30-day lates, 60-day lates. Now, again, defining lates. If your mortgage payment is due on the 1st of every month, and you make it on the 2nd, the 3rd, the 4th, the 5th, you get the point. That's not late. Matter of fact, you should have a grace period from the 1st all the way to the 15th. That's a traditional grace period. If you make your payment on the 16th, it's still not late. It's not late on the 17th. You get the point. It's late on the 1st of the next following month. It's late. That's when it's late. So that's a 30-day late. So if you're making a late payment beyond your 30-day cycle, then that's going to hurt your score negatively. Next one is 30% of it's how much you owe. Now, you can't really control what you owe on the mortgage because once you sign the note, that is the note. Now you're just paying it down, right? Same thing with auto loans. Now, you could go out and overspend on a mortgage and you could go out and overspend on a car, but most people stay within their budgetary means unless there's a life-altering effect that happens. So when we talk about how much you owe, it's not necessarily on the mortgage and it's not necessarily on the auto loans. It's on the revolving credit card. And this credit utilization, this is a term that we use a lot. Credit utilization is vital. So if you have a $10,000 credit card limit, I use $10,000 because it's a round number. If you have a $10,000 credit card limit, traditionally speaking, you want to stay below 30% debt utilization on that. So when the billing cycle comes out, you really don't want to have higher than a $3,000 balance on that credit card when the cycle comes out. If you could keep it below $3,000, but also above zero, that's the tricky part. But if you get it below $3,000, you're going to see what they call a credit utilization pop in your credit score. Like you are going to be rewarded in your credit score for having the right utilization of the debt load on that credit card. And that goes for all credit cards. Let's say you have like 2 or 3 of them. It doesn't matter that it's an overall 30%. Each card needs to be at 30% or less in order to maximize your credit score. 15% of this is also going to be determined on the length of your history. So if you're a newcomer to the credit community, let's say you're 18 years old, you're probably not going to have what we call credit depth. Now, there's a way to get around that, but that credit depth is really important. And the more depth you have in your credit, the more you're going to receive additional rewards in your score. Like it's very abnormal for an 18-year-old to roll up to the market and have like a 760 score. It can happen, but it's extremely rare. You typically don't start achieving those scores until you at least have some sort of depth. And depth is usually defined as like 10 years or more. Now, again, there are ways to do it, but most people, traditionally speaking, wait until they're beyond that 28-year-old range and start seeing the benefits of those higher, 700s, 800 scores. And the next one is going to be 10% is new credit. So how much new credit are you taking on? So we got 35% is payment history, 30% is the amount you owe, 15% is the length of history, and 10% is the new credit that you're taking on. So are you like trying to take on a ton of new credit? I've talked about this over and over on episodes before where you're just like, hey, I got to apply for this new card because, maybe it's got points that do this and it's better than my old card. Or maybe I'm getting more rewards and I'm getting more, points per dollar for this. Or maybe I'm just getting, a certain amount of money back, cash back per month. Like we know all cards differ, right? So people will apply based on what they see on TV, or maybe their friends are like, hey, dude, why aren't you using this card? I'm getting this back. So, there's all kinds of reasons why we open up new credit cards. You just might need one, right? You might have one that's quote unquote tapped out, or maybe you're doing the balance transfer game we talked about in the last episode or so about how to kind of move your debt around so you can pay it off. But there's other reasons. And then obviously autos and mortgages. They're going to look at that as well, like how many mortgages, how many autos, and then how many credit cards. That's all new credit depth. But if you go in this order, new debt being established in order of like what's going to impact your score more negatively is if you keep opening up credit cards, you're probably going to get the credit bureau not be too friendly on your credit score with that. Automobiles are a distant second, right? And then mortgages are a way distant third. So that's just something to keep in mind in that order. And then 10%, the last 10% is the type of credit used. And that kind of goes into what I was just talking about there, revolving, auto, mortgages, like that type of credit that's being used on there. All of that is crucial. So you have 35% in payment history, 30% on what you owe on your basically revolving, but also your auto and your mortgage, 15% on your time in the credit report, and then 10% of the new credit, and then 10% of how you use that credit. So I think that's important. All right, so now you have your credit score and you're in the credit system, but you're asking yourself like, hey, this is not where I want to be, or hey, I've got this amazing score and I want to protect it. Like, how do I maintain it? How do I stop it from fluctuating? I get this great score and it comes down, but I want it to stay in a certain area. If those are the questions you have, this is the episode for you. This is one of my favorite episodes because we're going to talk about how to hack your credit bureau. Now, I know that's a popular term between house hacking and credit hacking, but the reality is there's a lot of things that you as the consumer can do to your credit that really are up to you. And a lot of people don't share that with you. And that's what I want to do today. I want to kind of take you behind the scenes of how to maintain your credit report at the level in which you want it to stay at, as well as improving it if you need to improve it. So there's 5 factors: 35% payment history, 30% the amount you owe, 15% the length in the credit reports, 10% new credit, and 10% how you use that new credit. So I just want to run that back out there. So let's talk about that. So when we talk about payment history, I've always been told that there's this magic credit matrix. You ready for it? It's pretty simple. It's called the 1-2-3 model. How hard is that? 1, 2, 3. And what that is that the number one most important thing in your credit report is your mortgage. Number 2 is your automobile/installment loans. That could also be your student debt. Number 3 is revolving credit cards. Now, that's the order of the history. Now, here's kind of the formula. You want to have 1 mortgage, 2 automobiles, 3 credit cards. That seems to be the magic credit history matrix that's not really divulged out there. So think about that. If you're a renter and you don't have a mortgage, you're already at a disadvantage with your credit score because you're not getting the maximum amount of credit score you could get because you don't have a mortgage yet. And yeah, that's a thing. Now, here's pro tip number 1. Here's how you could help with that. If you're renting and you're renting from an apartment complex, or if you're renting from an institutional landlord, and that's not like, that wouldn't be me, right? If you were renting from me, I'm a single owner. I'm not an institution. But if you're renting from an institution or an apartment, get a payment history documented and turn that into the credit reports. You can work with any mortgage lender that you're looking to get pre-approved on a home with. They can help you with that, as well as there are opportunities to do that through TransUnion and Equifax via their website. So there's pro tip number 1. Number 2, installment loans, right? If you have an automobile, that's real important that you have it documented. But at what age did you get your automobile, right? Because that's going to go back to that depth of credit history, right? Remember, 15% of your credit report is based on your depth of history. So one of the things I always say is that when you buy a car at the age of 18, you can get that, you can credit qualify for that car. And there's really not a lot of car lenders that will not give you a loan. They want you to buy a car, especially at 18 if you got a co-signer with mom and dad. The real question is, can you find the automobile, lender or the automobile maker that'll let you be on there at the age of 16? Like, there are ones out there. You can start your credit history 2 years earlier. So that's something to consider. The third thing is in revolving. Now, this is the easiest way to get into the credit history, starting at the age as early as 13. You heard that right. As early as 13 years old, there are certain credit card companies, Amex being one of them, that will allow you to put someone in your family as an authorized user on that credit account. Follow me here. If 15% of your credit history determines your credit score. So if 15% of your credit score is determined based on your depth of credit history, and you start at the age of 13, by the time you're 18 years old, you already have 5 years of credit history. That accounts for 15% of your score. Now, if you recall, what makes up the bulk of your score? Payment history. So if you have 5 years of credit depth and payment history, you already have a leg up when you're 18 years old of a credit score. That's vitally important. Now, some credit card companies make you wait until you're 16 years old to add an authorized user, but there are some that start as early as 13. But even if you start at 16, you still got a 2-year payment history and 2 years of depth ahead of the competition, or, not really competition, but ahead of the credit reports. It's a great way to get started in the credit system and establishing a credit score out the gate. It's also one of the fastest ways to improve your credit score. For some reason you need to improve your credit score and you're beyond the age of 18 and maybe you had some bumps in the road or some things have happened, you can get established as an authorized user on any family member's credit card. And typically you see this with kids. You don't really see this, like, you're not going to your aunt and uncle and going, hey, can I be an authorized user on your account? You typically see it, what we would call as non-arm's length, mom and dad usually, right? And so mom and dad usually would put the child on the credit report or the or their, I guess it is child. So if you're 19, 20 years old, you'd put your kid on there, right? And you would help them establish credit, whether the credit card allows for it at 13, 15, 14, 16, whatever, and they put them on there. If it's later on in life, you can still do the same thing. And you can still help that person rehabilitate that credit score by putting them on there as an authorized user. So that's 2 of the main quick ways to get credit early on and kind of beating the system, if you may, and getting in there before the age of 18. The other thing is understanding your credit, like it's pivotal because the largest balances carry the most weight. That's why mortgage is number one in that matrix, right? It's usually your largest balance, and then automobiles and student loan debt's number two because those are usually your second largest balance. And sometimes those may be your largest balance, especially if you're, if you're new to the credit world and you got your first car. Because think about what's someone's first purchase they make when they graduate college. Typically, statistics say when someone graduates college or high school, their first purchase is a new automobile. It's not a mortgage, it's an automobile. So that's going to be your first payment. Excuse me, that's going to be your highest balance, your first thing on the credit report that pops up because it's your highest balance. But later on, it could be your student loan debt, and hopefully it's your mortgage. And those things will bring more value to your credit report than credit cards at any given time. But the earliest way to get in there is going to be put on as an authorized user on one of your family members' credit cards. But the largest balances carry the most weight in their scoring models. So that's why a homeowner, going back to what I said earlier, is typically going to have a higher credit score than someone that's not a homeowner yet. You don't achieve those high sevens and mid eights until you become a homeowner. You don't see that get up there because the biggest weight is given on that mortgage when it comes to establishing higher credit scores. So the other thing is this, when we talk about fastest ways to establish the credit, like I said, getting on there as an authorized user is extremely important. It's the quickest way to do it. Also, you can do it by establishing a traditional card. So for example, if you're beyond the age of 18 and you don't have a family member or the luxury of having a family member that'll put you on as authorized user, you can apply for a credit card. Now, at the age of 18, it's not going to be guaranteed that you get that credit card. But if you don't have anything on your history that's deterring the consumer lending division of the credit card company of approving you, you're probably going to get one. You're probably going to get one with like a $500 to $1,000 balance right out the gate. The question becomes, how do you utilize that? And go back to what I said earlier in the previous episode, is that maintaining a 30% balance is critical. Now, I want to clarify. If you have a $1,000 credit card to start, right? If you're brand new to getting credit and you were given the opportunity to get a $1,000 credit card, that means put $300 on the card, let it cycle through, and pay it off. So as it cycles through, you're not charged interest on it. We've done a whole podcast on that. So you put $300 or $250, $300 max on that $1,000 limit. Let the billing cycle through. Once it comes back through, pay it off. If you do that, you're going to see and you do that consistently, by the way, you're going to see a significant increase in your credit score, and your credit history is going to start with the proper utilization and also with the proper depth. And that's really important, going back to those 5 factors that I talked about. So I'm going to bring a slide up here on my computer because I kind of want to show you how trade lines work. Now, you're not going to be able to see this right now. My producer is going to probably put it in the background as I'm talking here. But I want to show you guys, this is from a fake credit report. I want to make sure you know that this is fake. Our friends over at Partners Credit were kind enough to kind of come up with a fake credit report and share this with us. So let's call this John Doe, okay, for the name on here. But what I want to show you is what a revolving account looks like. Now, what you're about to see here is a trade line from a fake Chase bank account, right? Fake number, fake everything. But inside here, what I want to show you is what lenders look at and what repositories look at when we talk about ratios. So on this trade line, first thing you're going to see is it says Chase Bank USA. That tells me that as a lender or someone that's looking at your credit, that this is with Chase Bank, that's your credit card company. I'm also going to see that it is a revolving account. And I'm going to have the indicator on here that shows me that it's a credit card at the very bottom here under the bureau remarks. You're going to see you're going to see XPN, which stands for Experian. You're going to see TU for TransUnion and EQF for Equifax. That means I am looking at a tri-merge that's reporting all 3 bureaus here. And at the very bottom, that says credit card, right? So that tells me it's a credit card. It also tells me in the middle of this trade line, it's a revolving credit card. So that revolving is important because remember, we talked about that on the matrix of the 1, 2, 3. This is the revolving section of that. It's going to tell me the date in which this reported was back in October of 2016, and that it was opened in May of 16. Now, obviously, this is an older trade line because we're using this as a made-up date here, but that shows me 4 months of that being reviewed. So the depth on this trade line is 4 months. So when we talk about length in the credit report, this trade line would only have a 4-month depth history. The balance on this, and you kind of see the red line with the arrow pointing to that, is $2,375. Now, the credit limit, which is where the opposite of that arrow is pointing, is $3,200. That means we have a 74% credit utilization here. This person is actually going to get a worse score on their credit report for having a 74% credit utilization. What we would like to see that be at is below 30. So if the limit is $3,000, keeping that below, let's just say $1,000 on a balance would really improve this person's score. So if I, as a creditor, were working with you, I would say, hey, Mr. and Mrs. Consumer, what I'd like to see you do here is pay that balance down from $2,375, just pay it down $1,375, and let's get a letter from Chase that says your new balance is 1,000. And I would take that letter and I would go back to the repositories and have them update this, and that would increase your score. That's something that you can do, right? But that's also something you can do as a consumer, that you can take control of this and say, listen, I know where I am. I've got my Credit Karma. I've got my FICO. They're showing me what my balances are. Okay, I need to start paying these down and get below 30%, and I'm going to see a real increase in my score. This is what we talk about when we say credit utilization. Let's go back to the very beginning of this here. We talked about 5 things make up the credit score. Payment history. So as long as you're making the payments on time, check. That's 35% of your credit score model. Another 30% is the amount you owe. That's what I'm referencing right now. And this credit utilization, the amount you owe, that is the other number 2 thing that makes up your score. So 65% of your credit score is comprised of payment history and the amount of money you owe. I just showed you how to improve that by making that payment down in this scenario. And if that applies to you, you will see a dramatic jump because that accounts for 30% of what you owe. And then the length of history. In this particular case, it's only 4 months. So probably not going to get as much, impact to the score because it's a rather new trade line. And then also remember 10% new credit, and then the other 10% is the type of credit in which you're establishing. So I kind of wanted to go through that with you so you can see this, and my producer Charlie will put that in there. But here's what I want to show you. In this particular scenario, I'm going to show you another screen here where we're showing a borrower that has a Capital One credit card. They have a high balance of a high credit limit of $5,000. They're utilizing 100, basically they're utilizing this card and they're maxing it out. What we're doing is we're showing them that if they can pay that card down and get that utilization down, what this does to their score. And there's a program that lenders can use that a lot of people use called Credit Expert. It's a wonderful, wonderful simulator that says, if I do this, this will happen. So if this, then that type deal thing. In this particular case, it shows if they were to pay this down, how their credit score would jump 30 points. 30 points. And you could do it in less than a month. So in some of these examples that I'm putting on here, I'm just wanting to show you what type of impact credit utilization will make as far as how you use your credit cards to your advantage. Because sometimes credit cards, I know they get a negative connotation in the industry because they're not taught how to be used real well. And I go back to this, last podcast we did week ago, we talked about why is this not taught in school? Like this could easily be a high school curriculum class on how to use credit card. It's simple math, the formulas work, and then you could improve your credit. Because remember, there's a tremendous difference in credit scores every 20 points. And, when you talk about getting the best interest rate on your mortgage, and you talk about getting the best interest rates on your credit card or the best introductory rates, all of that is surrounded by surrounded by your credit score. They don't look at anything else other than that. They aren't looking at really anything, because when you're offered this, they don't really know your income. They don't know your employment status. All they know is your credit score. And that's like the first key to opening the gates of getting the best deals. So I can't stress that enough. So that's how you can improve it, and that's how you can jump ahead of the line by getting an authorized user, utilizing your balances correctly, and having a great payment history. I mean, that right there is 80% of your credit score, those 3 things. So the next thing I want to talk about is obviously the collections, because that's important. And collections come in all different, walks of life. You've got medical collections, which are probably the most popular. You've got collections for debt that hasn't been paid that you agreed to. And then you've got bad collections, which I would say really bad, like a repossession or a short sale, or a foreclosure. Those are really bad collections. That's when stuff's gotten off the grid, not good, and you're possibly looking at something like a bankruptcy or whatever. But let's go to those first 2. Let's talk about medical collection, or let's talk about debt that hadn't been paid that's in the form of a collection. And these can happen for different reasons. Personally, I think the medical collection is the biggest scam of all times because, you go to the doctor. They take your insurance, they tell you there's no copay, and then 30, 60, 90, hell, maybe even a year later, you get a bill. You're lucky if you even get it. It might not even show up at your doorstep. But let's say you get it, and it's for like $108, right? And it's like, oh, for testing that was ran, blah, 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 your insurance company disagreed to it, so here's this bill. you're questioning, like, I don't even remember last week, much less a year ago. What the heck is this for? You call the company, they don't know, whatever. So you have a choice. You either pay it or you don't pay it. So let's say 50% of the people say, screw it, I'm going to pay it because I don't want it to show up as a collection because they know how that works. And the other 50% say, I'm not paying this. I don't owe this, right? So if for some reason you have a medical collection just show up on your credit report out of the blue, again, I would venture to say probably 50% of the credit reports in America have a medical collection on it. There's a couple things you can do to improve that. So think about this. There's no difference, besides financially, on a credit report scoring model. There's no difference between a $10 collection and a $10,000 collection. And I know people will argue with me on that, but that is not the case. A collection is a collection is a collection, and that's how it works. Now, the good news is this. If you pay the collection off, you need to get a payment letter from the collection company that says, hey, listen, this has been paid in full. And then also that collection company has agreed to remove that from the credit report. It is now settled. It is removed. Now, sometimes they don't agree. There is recent, I don't want to say legislation, but there's recent rules that have come out as of August 22 that state that if you pay off a collection, it can no longer be held over your head. It should be removed from the credit report. Sometimes that's not always the case, but 99% of the time it is. If it's done correctly, it is. If that collection is removed, you're going to see a significant increase in your credit score. Sometimes it's 30, 40 points. Again, I'm going to pull up another example here. Our producer is going to put in the show notes, and you can see all these show notes on our YouTube channel at What's Your One More with the number one, at What's Your One More with the number one. Again, love the comments and feedbacks you guys are putting on there. But I'm going to put a negative trade line. So we just showed what a trade line was. This is going to be a negative one. This is actually going to be, again, from John Doe, and this is a fake credit report. But this is what a collection looks like when we get it on a credit report, right? So this collection is showing up. Now, what's interesting to me is it's only reporting to one of the three repositories. So in this particular case, whatever we do is only going to make the Experian credit score go up, because in the very top, you'll see this is a highlighted in gray, highlighted in dark charcoal gray trade line. Now, some lenders highlight them in yellow. I mean, it's whatever, but it's differentiating from that normal line that you saw before. And this is alerting people that, hey, listen, there's a collection on here. And in this particular case, it's on Experian. I reported back in May of 2014 in this particular case, and the balance is $456. So $456, and it is literally a medical collection. And it's with an attorney's office right now, and you could settle for this, and you may not even have to pay the full $456. Maybe you pay $200. Maybe you pay the full $456 in this case. Whatever it is. But what's interesting about this is that we see these all the time. And in this particular case, I stand correct. This is not a medical collection. In this particular case, this is Pacific Bill. This is actually like a phone bill collection. We do see these too from time to time. But these are normally medical collections. But we do another credit expert, and you can see how this increases 40 plus points just by paying off a medical collection, and you get it deleted from the credit report. And so again, if you're working with a lender, they can help you with this. If you're looking at your Credit Karma, or you're looking at, your MyFICO, and you've been alerted, you have a new collection, pay that thing off as fast as possible. Just pay it off and get it deleted as fast as possible through the collection agency, whether it's a medical collection agency or not. All right. Last thing I want to touch on here, because I think this is just as important. So let's say you have an amazing credit score and you want to make sure you maintain that credit score. So what we've done for the first half of this podcast is we've talked about how to improve your score. But let's say you're like, Q, I'm good, man. I've got like this 720. I'm cruising. Yeah, I want to get to a 740, but I know that comes in time. Or I got a 740, 780. I hear it all the time. And you want to maintain that. First thing you want to do, that credit utilization. Like, how you got to that credit score. Continue to make your payments on time. Don't go over the 30% balance. You're going to see that play a significant role in that score. Another thing, if you've got other credit cards that you're not using, all right, this is pro tip number 2. Do not close them out. Like, do not close out your credit cards that you're not using. Like, I've got a credit card that I've had since I was 18 years old. I don't use it. It sits in a safe at home. It drives the living hell out of me, because I'm like, oh God, what if something happens on that card? What if I'm checking it, making sure there's like no fraud on it. But I know if I close that card out, I lose 20 plus years of credit depth because I closed that out. Even though I'm not using it, I'm going to lose 20 years of credit depth. That's going to damage my credit score. So, and that's exactly what happens. And isn't that crazy? We get like this false notion like, hey, listen, pay off all your debt, close out your credit cards. That makes sense to me too. Because shit, man, I want to be financially free. I don't want to have that stuff lingering over my head. So pay it off, close it out. Well, no one tells you closing that out could cost you 100 points. Like, don't close that credit card out. Put that joker in a safe. check it online once a month, make sure there's no fees being charged, make sure there's no activity on it, right? Especially if you're not using it. But that brings up another point. That card may have an annual fee attached to it. Okay, if it has an annual fee attached to it, here's something you're going to want to make a decision on. Do I close it out and I'm going to suffer the points? Excuse me, I'm going to suffer the points on my credit report. I could lose it. Or do I put a reminder in my, Outlook or my calendar on my phone, and I say, hey, listen, annual fee due at this time. Because what happens is with a lot of people is they forget to pay the annual fee, and 60, 90 days down the road, that thing is now late, and you got a 60 or a 90-day late on your credit report because you forgot to pay the annual fee because that thing's been sitting in your safe. That's a reality. That happens all the time. So you just got to make a choice. Either use the card, don't use it, and remain active on it, and then you know exactly what's happening, or don't use it because it's not beneficial to you anymore. Close it out, lose some points, or put it in a safe and put some reminders on the annual fee dates so you know exactly when that's due so you don't get stung on that. So keep that in mind. Another thing to do is if you are, you're using the credit cards, you're not using the credit cards, we just talked about that, but you have the score you want. I would highly recommend a really sophisticated credit monitoring system. A lot of people will use LifeLock. They're probably number one. ID Shield is number two. If you're using a Chase card, if you're using Amex, Discover, any of those major ones, they're going to have a credit journey or a credit identity or a credit tracker built in. And if you're not using that, that's free of charge. You automatically get that as part of your credit card. So you should be able to find that tab. I'm looking at one right now from Chase called Credit Journey. You just click on that and it will walk you through. And it's done pretty well. But again, it's on the premise of that Credit Karma system I was talking about, that Vantage 4.0. So it's not really getting the same look as what lenders look at. So it's going to be a different scoring system, but you get an idea of what's showing up in your credit report. The idea behind having something on your credit, monitoring your credit is exactly that. It's not necessarily to get the score, it's to monitor your credit. You want to know if a medical collection shows up. You want to know if something's being charged on your credit card that you're unaware of, whether it's this card that's monitoring it or it's other cards that you have. You want to know if your credit's been pulled. They'll tell you that too. That's important. A question we get all the time. Hey, listen, my credit score was pulled on June 1st, and then it was pulled again on June 15th, and my score fell 30 points. It's probably not why your score fell 30 points. I mean, if you noticed in, the things that make up your credit score, 35% payment history, 30% the amount owed, 15% the length of history, 10% new credit, 10% how you use that new credit. I didn't see any percentage in there on how many times your credit was pulled. That's because that's not the case. The irony is in that scenario is that your credit's pulled on the 1st and then it's pulled again on the 15th. It goes back to those rolling billing cycles we talked about. There's probably a creditor that popped in there in that 15-day window and reported a new balance. And that new balance is probably what drug that score down. I can almost guarantee if you took both bureaus and put them side by side, one of those trade lines has a higher balance over 30%, which is what dropped your credit score, or medical collection popped up, or you missed a payment. Any of those things could happen. It's not because someone pulled your credit. And I know people will argue with me all day long on that, but that's not what's causing that credit score to fall. And that is not part of the credit scoring model on here either. All right, last but not least, maintaining that great credit score is be a conscious credit user. Again, I think that's one of the biggest things that gets missed here is that people aren't always monitoring and looking at their own credit. I mean, treat that thing like you do your monthly paycheck or your weekly or your biweekly paycheck. Treat that thing like you do your mortgage statement. Like look at your credit on those sites that I'm referring to and take an opportunity to make sure everything on there is accurate and correct. And then also start building up for your kids. At the early age of 13, you can start adding them on there. And then if you're beyond 18, work with your parents to get put on, if they haven't done it yet, work with your current parents to get put on as an authorized user. Extremely important, great way to build depth, great way to build a payment history on there. So welcome back to the What's Your More podcast. I'm your host, Quentin Harris, and today I am joined with an amazing guest. I'm very excited in our third-part series of how to improve your credit. I'm actually bringing you guys, as promised, the Wizard of Oz behind the curtain, the person that you as a consumer cannot talk to as a real estate agent. Oftentimes you can't get in contact with, and I'm very excited today to have Tracy Donadio on the show with us today. And to tell you a little bit about Tracy, it's just short and simple. Since joining Partners Credit Verification Solutions in 2003, Tracy has held several positions within the company, allowing to take into consideration different perspectives while contributing to the overall operation of the company. For the last 7 years, her role has been as COO, focusing on evolving the company based on customer needs and market demands. Tracy attended DePaul University and majored in conflict studies, which one would think has nothing to do with the mortgage industry, but was a wonderful foundation for her business and raising her two daughters. Tracy currently sits on the Preferred Partner Association Board of the Mortgage Collaborative and has heavily involved with charity work and community services in the Chicagoland area. Tracy, welcome to the show. I'm so excited to have you on here.
Thank you.
Yeah. So
Wonderful to be here.
one thing I didn't put in there is that not only that Tracy's a personal friend of mine. I've known her for the last really 5 years here, and she has been a huge influence in our business and our customers and our solutions for that. And that's why I'm excited to have you on the show today.
Thank you. I'm excited to be here. And yeah, it goes both ways. You've been incredible. And, there's always a fine balance between the vendor and the lender. And when you can have dialogues that make sense where both people are listening, it can be so advantageous. So I've always respected you and I'm excited to be here.
Oh, we're excited to have you. Thank you for those kind words. And I think for our audience here, we've been talking about customer credit. We've been talking about what they can do to improve their score. But let's kind of take it back here. So Tracy's position for our audience, just so you understand, there's three major repositories. There's Equifax, there's TransUnion, and there's Experian. And those all come with different synonyms with them, like FICO, Beacon, so forth and so on. Fair Isaac. Tracy and her company at Partners Credit, they are the liaison I keep talking about on the first episode that kind of allows lenders to understand what those repositories have data on for you as the consumer. And so for me, I can't go directly to, as a lender, and no lender for that matter, can go directly to all three repositories and have any type of electronic relationship with them, if you may. You have to use a third-party liaison who is licensed and verified to protect that data and ensure that data and deliver it to you as a lender so that you can have the loan and give it to the agencies when you go to securitize that. They have to be verified. Tracy is one of a select few in her company that do that. So I kind of want to set the tone for who you're talking to. That's why I said the Wizard of Oz, because as a consumer, as a real estate agent, as an audience member, like, you can't get to Tracy. But today we're bringing Tracy to you. So I'm very excited about that. And she gets to see all the good, the bad, and the ugly about credit. And she's helped debunk a tremendous amount of myths about credit as well. And we're going to talk about those later on the show. So to kind of get right into it, Tracy, what is it that you think is the biggest misnomer in credit right now between the consumer and, really, let's just say, the consumer and the credit bureaus? Like, what is the biggest challenge you're dealing with right now in this industry?
Well, there's so many.
Yeah. How much time do you got, right?
I know, right? In terms of, I think there's what the consumer understands as their credit and what it actually is. The great thing is the last few years, the consumer has more access to their credit than they ever had before. They also have access to 10,000 different people telling them how to improve their score, or I shouldn't say that, how to become more financially responsible. That doesn't necessarily improve their score.
Right.
So I should say that. And there's a lot of different voices with them, or they see, oh, well, I pulled my credit and my credit has this score. And it's great that you've been talking to people about different score models that you have. So when they're coming to you, the lender, well, what did you do to my score? What did you do to me? This is what it was, and now it's suddenly changed. So I think there's a lot out there of kind of where they think they are versus what they need to do. And I think that it's important for them to understand who the professionals are, and for, loan officers and real estate agents to talk to them and make sure they're going to the proper resources to get the right information that will help them get the house that they want to get and the mortgage loan that they want to get.
Yeah, we get a lot of time from customers, like in the pre-approval process or any type in the loan process. They go, "Oh, my credit's X," and they want you to give a proposal based on that. And one of the things we talked about was, you just hinted towards it. There's so many different models, many different models. So can we take just a second to maybe explain what I always say the mortgage credit pool is the most comprehensive credit pool that you will get as a consumer. It tells us so much more than even an auto loan, because oftentimes the auto loan may just look at one bureau. We're looking at all three. And what the data is we get from you doesn't necessarily show up on that auto report, much less that credit card report. We find out, where you've lived over the lifetime of being in the credit bureau, your jobs, as well as your credit scores and every account you've ever opened and closed, as well as any judgment, filings, medical, it goes on and on. When you're dealing with Credit Karma, or you're dealing with your credit card companies like Experian Journey, as they call it, those aren't the same. And oftentimes those scores are more inflated on that side than what we would see. Can you kind of break down a little bit of the difference there?
Well, if you think about it, this has to be the most comprehensive approach in terms of looking at you as someone that a bank is going to give money to,
Mhm.
because it is going to be the biggest investment that you're going to have and the biggest loan that the bank is going to give, basically, if we look outside of, commercial lending.
Right.
But this is, you're dealing with a borrower. They really need to understand who you are as a consumer. So you need to have, there are three bureaus. They have different ways of weighing the score. They have different ways of looking at the data. And there's some things that I don't want to go too far in the weeds, but there's data that loan officers don't even see on the credit report, something called trended data. And what that data does, and to what Quentin is saying, we resell this data. We're getting the data to protect you as a consumer so that the lender doesn't have this direct approach to the bureau. So we're supplying the data and passing it through to these agencies that are going to loan you the money. And part of that looks at how you're actually making payments on a monthly basis. That's called trended data. So it's not saying, your credit report, think of it as a snapshot in time. At this moment, this is what your score is. This is what you made as a payment last month. Trended data says, well, and this is what they did the month before. This is what they did the month before. And it gives the lender an idea of kind of your history of how you're making the payments. Are you making the minimum payment? Are you, spending a lot and also paying off a lot? It's giving a comprehensive approach to understand, are you a risk? And it's a hard thing to hear, but it's a risk. A loan is a risk. So
Sure.
they need to make sure that, who they're providing that money to is a less riskier person than somebody else. So that's why the score matters and why, rates change is how big is their risk. And you want them to understand the most about you so that you do get the proper score. And so that's where credit recently, and I know we're going to go into it later, of looking at, medical collections, why that's starting to change in credit, of
Mhm.
how that's reported, because there's a difference between someone that decided to get their nails done versus pay their credit card,
Right.
and someone that's had a life altering event happen that has skewed the way that they are able to pay their bills. And, they might default on their medical history, but that doesn't mean that them as a consumer is a risk. That's a life changing event that has changed their circumstances.
And, for years that wasn't accounted for like that. That's a recent update. We're going to talk
Right.
about that here. But, to your point, Tracy, I always say, look, when you look at Credit Karma, if we could use Credit Karma as an industry, we would do it. That's the other
Yeah.
thing. The other thing
Right.
is, I just, earlier when I was talking about there's certain third party vendors, that's what Credit Karma is. They're a third party liaison, but they're not approved through the government agencies to insure these loans. There's a reason why we can't use that, because it's not as in depth to what you just referred to as. And to me, while customers have more access to their credit, I wish it was more unified. And I know you do
Yeah.
too, because it does give a false sense of, I don't want to say security, but a false sense of ideology of what you're going into, because you're like, well, man, I'm a 780. I deserve the best of the best. And then you get your credit pulled and you're a 721 and you're going, wait a minute, how did that change? And then that leads to the debate of, well, you pulled my credit, so my credit went down.
Yeah.
And, and I want to talk about that for a second. Break down the myth of this, because you've done it so well. I've heard it so many times. We have customers that, and rightfully so, they've been told this, or they've assumptively have come up with this based on a situation that's happened to them. But here's a great example. My Credit Karma score is 780. You pulled it, got a 721. My score dropped. Well, we just explained the differential there. So it could be that. But
Yep.
let's assume we're comparing apples to apples. And, customer went to lender A, had their credit pulled, and they're shopping a deal. And then maybe 3-4 days later, they go to lender B and they're like, you know what, let me see if I can get a better offer, which happens all the time. They have their credit pulled and their score drops. Well, we're looking at two of the same pulls. Shouldn't the score be the same in 3 to 4 days? You want to break down why that oftentimes is never the case. And by the way, I don't use the word never often, but I'm
Right.
going to use the never right here. So you want to
Right.
kind of walk them through that?
Yeah, there's two parts to it. First, as I mentioned earlier, when you pull someone's credit, it is a snapshot of that very moment. And credit is fluid. There are different creditors out there. If you could have 20 different creditors on your credit report that each report to the bureaus at a different time. There's not like, hey, everybody, today's the day that the bureaus are updating their information. We wish we knew that,
Sure.
but there isn't.
So guys,
So
so just to understand briefly what she's saying is that if you have multiple credit cards, you have an auto loan, a mortgage, they're not all going to report on the first of the month. They have rolling billing cycles, and we've done a whole episode on what that means. If you want to know what that means, tune back into that episode. But rolling billing cycles is what she's referring to.
yep. And so that can change. So yesterday, if you pulled my credit and I had a credit card that had a $500 balance on it and my limit was 2,000. Well, then they reported it differently. You pulled my credit today and my credit score changed by 20 points. Well, guess what could have happened? Either I went shopping and now it's reporting that my balance is at 1999
Mhm.
and it's right next to it. So you have to kind of look at everything that's on your credit report and know that it's changing all the time, which is why, we talk about like don't go on a shopping spree, don't do things when you're in the loan process.
Right.
But the next part that's really important to understand as well is that there is a grace period as well. When you are applying for a mortgage loan, there's a grace period. It's different with all bureaus, but the main one, the shortest one, is 14 days. You have 14 days. And where different inquiries, so different people pulling your credit will not affect you multiple times. And then the next thing to know after that is that even if you did pull the credit, it takes 30 days for that to have any kind of impact on your score. And I want to say this inquiry, in thinking about all the things impacting your score, that is going to be a sliver
Yeah.
of what you need to be concerned about. And you can work with someone and other changes to make. If your score is low and you're trying to increase it, it's not going to be like, well, I don't want you to pull my credit again after I do all this work. No,
So
we take that into
I
consideration.
want to unpack that because that was a lot of really good points there that I think the audience needs to just if you get anything from this episode, this is what I want you to get. What I just heard was if you're shopping for the mortgage, you're
Mhm.
automatically given a 14-day, at minimum, a 14-day grace period to look around. And I think that makes sense because if you think about it, why on earth would the credit bureaus punish you for trying to find the best deal? They're going to give you 14 days to do that. And I think that is a huge fact to take away from this conversation because I oftentimes think my industry uses that as a leverage tool to scare customers and tell them,
Mhm.
hey, listen, if you just I've got your score now, but if you go shop, it could fall, and then I can't guarantee this rate. Like I've actually heard competitors use that as a tool, and it's gone on for way too long. And it takes a long time to kind of debunk this. But I really appreciate you saying that because that's what I was hoping you would talk about is that 14-day grace period. That's really important.
Yeah.
And
And
go ahead.
to your point, it's kind of like a switch because it
Right.
might have gone down when you went to a different person, but that's because your credit changed. It
Right.
wasn't the end. Yeah.
Right. And what happens is, borrowers get excited, they buy furniture, they start putting in things to be delivered. And that's the shopping that you're referring to there. And I totally understand that because that's something that we've worked on educating as an industry for a long time. But this leads to another question. Do you think the credit, like, is there such thing as credit reform? Do we need credit reform right now? Because I know Vantage 4.0 is coming out or is already out.
Yeah.
And I saw a statistic to where the Vantage 4.0 model has now made over 6 million borrowers lendable in the new guidelines. They've taken their credit scores from, I see you smiling right now, because it's taking credit scores from below 640 and has now put them in that 640. And I say that for our audience because that seems to be the standard bottom, if you may, right now in our industry as of right now being lendable. And so maybe
Mhm.
620, in some cases, I say 640 because it covers all products, but 620, 640 in that range. It's taking those borrowers above that to where now they are eligible for a mortgage in this 4.0 model. And there's some people going, this is great. Then there's some people going, hey, listen, you're messing with the risk model here, and that could
Right.
lead to potential issues because they may have a credit score of X for a reason, and we need to have that in consideration. What's your thoughts on that?
Mixed.
Mixed, okay.
Yeah, and here's the reason why and why I was kind of smiling with that. So, yes, there's going to be a new Vantage score. What their platform is saying the key word
hmm
is potential to bring in borrowers that were not score worthy previously and be able to give loans to kind of the borrowers that were marginalized before not being able to get there. So it does talk a lot about minority lending, how this is going to open up avenues for it. I think that there is two sides to this where, how do we score borrowers? How do we look at your risk? And part of Vantage is saying, right now, If I have my daughter, who's too young, but if she was a little older, go out and get a credit card, she would need to have, in order to get a score on her credit report, with our current mortgage model credit report, she would have to have 2 credit cards that have been in existence for 6 months.
Okay.
With the new model, they're saying it's 1 month can start to get you, okay, what can you tell from somebody in 1 month?
I agree.
Now, I understand the eagerness of someone that's like, listen, well, I just never had a credit card. I've been paying my bills. I pay my rent every month. I pay all my utility. I live in an area where, they taught me like, don't get lost in credit. There I do see something,
I agree with
right?
that too. And there's a
I
history
think
with
that
rent,
there
and there's a
is,
history with utilities, and you've been consistent with paying those. I think that should show up on the model.
I do as well. Or a way to access that information to make it usable.
I
So
agree.
right now you kind of can. It could be a manual underwrite, which basically means you kind of like share all this data. It makes it really arduous and difficult to do.
Right.
So I do think in some ways, the problem with reform in this and the problem of getting utilities and landlords on the credit report is that the majority of landlords could be a mom and pop shop where they have 2 buildings.
Could
Are
be
they
you and I.
reporting
Yeah.
bureaus? Yes. So it's not easily accessible.
Right.
So I'm, until we have a way to do that, I think information like that should have some weight to it, a way to, whether it's by banking records or something that we
Mhm.
can easily access that and that could be used for credit. But if we're changing the way that we value risk or trying to make it easier to get in, I'm hesitant.
I
But
agree with
we
you.
won't see it until we see it. And part of the new score is going to be a side by side version of,
Mhm.
and I have to look at them against each other. I think that's going to really start to change the discussion and see what really is the difference here.
Right.
And
And I think it's really important for our audience. You understand, like, by no means is Tracy and I arguing that certain people shouldn't have the opportunity to get a loan. That's by no means. What we're saying
not
is
at
that
all.
from a risk assessment, let me paint a picture here. If your price point, I'm just going to say $400,000. Let's say your price point, I know in Chicago where you are right now is not that, but let's just say it's $400,000, and you're going to put the minimum down payment down. So you're bringing 20 grand to the table, and the bank's bringing $380,000. The risk is definitely on the bank. And, I know a lot of audience will argue with us that the banks can afford to lose that. The banks are ripping people off. I've heard it all. But the reality is this, it's still a risk assessment model. And I think to your point, 1 month of good pay history cannot determine a loan of that magnitude. However, I think if we could get the utilities to streamline, since they're online and they're validated, cell phone validated, if we could start getting that stuff to report to the bureaus, and for our audience, the reason people don't report to the credit report is it costs money. It's not cheap.
Mhm.
It costs money. Typically, you have to batch the data, then you have to report that batch data, and you have to have a department that does that and validates that. This isn't like right click, create a CSV file and upload. Like, there has to be you're creating new jobs, you're taking on additional expense plus the money to report. That's why they don't do it. There's a lot of hesitancy behind that.
And there's auditing to it. Like,
Right.
beyond if they have to how do you validate it? Where does, who does it come back to if that information's not accurate?
Correct.
So it's very complicated. So I'm glad you reiterated that. I'm not saying that as well. I'm saying if we're going to look at credit reform, we have to look at the data that we're getting, how we're getting it, and what we're accepting. So does it stand at just a credit report, or can we start looking at, other data points that you can validate? So if
Mhm.
we can't go directly to the mom and pop landlords, can we start using, if they do direct deposit every month, then
Right.
that's considered criteria that can be added in somehow to it.
Yeah,
So
validate.
I'm more on that page, but again, glacial pace
Yeah,
to
and I
get
mean,
there.
just to be transparent, we're probably looking at a minimum of 5-year adoption plan here. This isn't happening in the next 30 days, the next 6 months, the next year. We're looking at a massive time frame for adoption, widely adoption. And if I had to guess, just based on my time in the business, it'll start at a small test level and work its way through the system. It won't be a widely massive adopted.
Yeah, and there's things out there right now. Experian Boost, and people will be like, "Why do you Experian Boost?" But that Experian Boost still, it doesn't count towards the score, so it can
Correct.
show some of that information, but ultimately it's not scorable. So ultimately, if you're sending it to the government agency, they're not using it.
Right. And we
So it's a
battle that a
little
lot too.
smoke and mirrors.
Yeah, we battle
Yeah.
that a lot. A lot of customers it took about a year and a half to overcome Experian Boost and what they were doing out there. That doesn't qualify on our side, unfortunately. And I wish there was a disclaimer that explained that, but there's not.
Right.
So,
Yeah.
let's talk a little about collections, because I think this is probably the most recent credit reform, if you may, that we've had that I think impacts the consumer at such a high level. We had a gentleman on our show back around episode 60 plus or so, and he owned a healthcare insurance company. And what we were learning quickly is that, when you go to the doctor and you're sick, you want to get taken care of, or you're hurt and you want to get taken care of, this ideology of, hey, I'm not going to tell you how much this costs. I'm just going to get you taken care of. And then I'm going to send you a bill later. And that bill is non-negotiable unless your insurance company negotiates it for you. But if you're out of network, you're kind of stuck. You don't know what this cost is. You just wanted to get the problem resolved. So you do it. You sign away your rights, and then you get this bill. And sometimes you don't even get the bill. Like sometimes it gets lost in the mail, or you don't know what it is, et cetera, et cetera. But you get this medical collection. And for my entire time in the mortgage industry, these have been rampant. And I mean, right, wrong, or indifferent, they'll just show up. And it could be as little as $10 all the way up to thousands of dollars. But the $10 one is just as painful as the $10,000 one as far as a score impact. And so as of recently, we've had some rules come out that have said, hey, listen, you know what? You're the expert. I'm going to let you walk us through. What are those rules recently said, Tracy?
So there was one. It started with that medical collections that were under $500, paid or unpaid, were no longer eligible for reporting. So, which is huge, because like you said, we were seeing things that were like $23, $15. And if you've gone through anything with a family member yourself, to your point, sometimes you're getting a million different bills from different departments. You think you've had it covered. Somehow this one got lost somewhere and they didn't even know they had it. Cause it's like, okay, well, you've got, you're paying a $500 car payment. Why didn't you pay the $23 medical collection? You didn't know it was there. And then later, that any medical bill that is greater than $500 and has been sent to collections, it cannot be reported for at least 12 months. So it's giving the borrower some time to be able to make some payments on it, get rid of it. Again, recognizing this is probably a fluke. It's not something that's typical for them. And down the line, medical bills and collections, hopefully, will completely be gone from credit. That's the next thing that's in the pipeline that people are talking about, decisions are being made in regards to. So that's huge. But one thing that I do think is important for a consumer that's listening or someone that's giving guidance to someone is that with collections, you do have some leverage, and there is some conversations that you can have while you're making that payment. And it's important to do, saying, you're calling the collection company and say, I would like to make this payment, but I would like for you to agree to remove it from my credit history. They have the power to do that. And sometimes that's a small negotiation tactic. Like, I'll pay it if you agree to remove it. Oftentimes they will. And especially if it's a medical collection, and it will come off anyway if it's, under zero after a certain point. But it's important for you to do that and ask them for a letter in writing so that you're able to hold on to that and have validation of that so that you can have that medical debt removed or collection from your credit report, because your credit history and your derogatory information, that's accounting for the majority of your score. So your payment history is paying accounts on time, late payments, or collections. That's 35% of how your credit score is determined.
It's really important that you understand that payment history, that's the bulk of the credit. That's the major factor there. And what Tracy's referring to is as we move that medical collection, the payment history improves, which is why you get such a big jump in your credit score.
Yep. And it can jump. I mean, we're talking about what you were talking about before, going from a 620 to a 640. That could be a 620 to a 680. It's
huge. And as an example, on the previous episode of this, we actually took some of the slides that you provided to us with the trade lines, and we showed what a trade line is. We showed the collection that you had in there, and we showed what it did for the score boost on there to what you're referring to. And it was a 47-point jump. So again, this is important. Now, I think the key takeaway there is, and I want to make sure we reiterate this to our audience, it's not just medical collections, it's any collection. And you want to negotiate, if I pay this, you will remove it from my bureau and you will provide me with a paid in full letter. Guys, this is not abnormal. Like, this is everyday practice for them. And so them saying yes should be pretty simple. For them to say no, there has to be something really wrong here. But they'll say yes to this, and you get the letter. It may take 24 hours to get it emailed or faxed to you or mailed. But when you get it, if you're on the loan process, you can provide that to your lender. They have the ability to fast track that into the 3 bureaus using a partner like Tracy's over at Partners Credit, and you can accelerate that, and that's called a credit rescore, and you can get that removed pretty quickly. So there's the power in having that letter to get instantaneous removal.
And it's hard. We are so personal attachment to our credit history. People are very, very sensitive about it. And sometimes taking that deep breath to just open up the envelope that says the bill, then to actually call that place and say, okay, I want to, I think what you said is huge, Quentin. This is their day-to-day. This is their life. They talk to a million of you a day.
Yep.
I know it feels a lot that it's you, like, oh, did I screw up? Like, what have I done? In that moment, claim it. See what you can do. If you have a dream to get where you want to be, use it. And it's okay. No one is judging you. It has happened to us all, even myself.
Right.
We've all been there. We can't always, life happens. We make choices. We make mistakes. Now, if you're on that journey to make it better, then make it better all the way. Don't just, get it paid, but see what you can do to really drive it home.
Yeah, we talk about this all the time on the show. We preach this. I know it sounds like a broken record, but if you communicate with your creditors before the situation gets bad, you would be amazed at how much they will work with you. If you wait until it's, irrecoverable, their hands are going to be tied. They're not going to be able to work with you as much. So being proactive in these measurements is what Tracy's referring to. It's huge. It's absolutely huge. And I can't recommend that enough because, as you said, we've all been there. So we know it works. Yeah. It's really, really important. Yeah. So, Tracy, as we start to wrap up the episode here, I want to talk a little bit about this last topic, which is, okay, I'm driving down the road. I see a billboard. I see signs. Will improve your credit, or, a credit score improvement, or credit. I mean, I've seen them all, right? Call this number. Can we talk about why people don't want to do that? Can we just briefly touch on, this is not a great idea. This is not, this is a waste of money. I just want to go ahead and buyer beware.
Buyer beware, because, and also it's for free and it'll be great. Nothing is for free. Also, if someone is saying that they can do this and, we'll take care of everything. And as we spoke before, we've all had instances in which it could bring our score down. Okay. And some are more significant than others. Typically what they do is they just barrage these people with, no, they didn't, no, they didn't, no, they didn't.
Yep. Dispute.
Okay. So all that does is it puts a dispute on your credit trade line. So the trade line is the information for that one specific creditor. So now your credit report has that information. The dispute mark is on it. They have to investigate it. It takes 30 days to investigate and if it comes back, you just have a dispute on there. It's not improving your score. It might temporarily, kind of, because it's basically just muting it a little bit.
It's exactly.
But if you're actually going to go try to get a loan, guess what? You can't have on your credit report with existing debt. You cannot have a.
Yeah, you can't have that dispute. So you're going to have to get that dispute removed. And that's going to be the problem here, because as soon as the lender, quote unquote, unmutes that dispute, well, guess what? That score is going to come right back to what it was. So it's fool's gold. And so, it's a great analogy. I love that mute, unmute. That's a great way of putting it.
And it's wasting your time. So even though they're like, we can do this right away, here we go, we're going to get this going, it's wasting your time, because if it is truly inaccurate, if there is inaccurate data on your credit report, you can go directly to the bureaus. There's a great website called annualcreditreport.com.
Love that one.
You have access directly to the bureaus where you can then say, this is not true, or go directly to the creditor. This is not true. Get it in writing. If it is true, and it is something that has happened, and there is a negative impact on your credit, You should rather be focused on what you can do to rebuild, which is not what these people are telling you. What they're doing is fighting to try to get rid of any information that's negative on your report, putting that dispute on it. What you really should be doing, who you should be calling, is someone that you're trying to get a loan with. That is not everybody, because not all lenders are created the same. And I will say that, and I'll fluff you up, and Quentin, and your branch, is that what you guys really do is you seem to work with borrowers. A lot of times people call lenders, and I've done it myself, where they fast talk you. I could do
Right.
this, I could do this, do this, I could do this right now, right now, right now. Rather than, we could do this today, or in 60 days, I can get you, what's your timeline look like? How quickly do you need to move? Do we have time to improve your score?
Right.
That is key. And if it is a good loan officer, if it is a good lender, if, at realtors, and this is important for you to know who you're working with, are they going to take the time to educate the borrower on how to get to a better place? And that's typically, let's look at your credit. Let's look at your debt. Let's look at how we can bring you down to a ratio. And I know you've talked about it on different episodes, of your credit limit versus your balance. How can we put you in that sweet spot? And let's see how we can get your score up. That takes time as well, but it gives you a broader understanding of what you as a borrower need to do, versus pretend it's not there and like, oh, you can get it away from me and my mistakes. It's there. It's
Right.
going to be there. It's happened. Now, how do we rebuild?
Yeah, and I think that annualcreditreport.com link, we'll put that in our YouTube channel at What's Your One More with the number one. But the thing that I really want to harp on here is, what I'm hearing is there's no such thing as a credit repair expert. And what I'm hearing is that the lenders, no matter what lender you're working with, for the most part, have the tools to give you scenarios that say, if you do this, then this is possible. Not like, hey, I'll just dispute everything and it'll unmute and then run your score up, but you got repercussions later on you got to deal with. The lenders will actually fix it, and it's actually a permanent fix. It's not a temporary fix.
Yeah.
Now, it's not going to cost you, the borrower, money in the form of the lender's going to charge you to do that, but there may be some balances you have to pay down, and that's where the money comes in that you would pay. And that's, to your point, no such thing as a free lunch. But I think that that's important, that really the only credit experts that a consumer can go work with is their lender. It's not it's not the sign you see on the side of the road. So I really appreciate you touching on that and kind of letting the audience know exactly the buyer beware sticker on that. I'll leave with this. So I always have thought, I own 3 dogs. I got 2 golden retrievers and a King Charles. And anytime I say, do you want to go outside? Like, their ears perk up and they turn and look at you. That's how I feel consumers are when I'm like, all right, we're about to pull your credit. And literally the ears perk up, and you will never have a borrower's greater attention than that moment right there, because it leads to your point. Everyone is so, they're kind of in a way insecure about their credit, even if they know what it is. It's that deep breath of, what is he going to say? They're going to pull it, because we're about to learn everything about your past and what you've been doing as a borrower, and the agreed upon mutual payments that you've made with your creditors. It's a scary moment. And, and I want our audience to understand that there's ways to take control of that, and there's ways to improve that, and there's ways to do it to where you don't get ripped off, and there's ways to be methodical about it and understand the difference between what you're seeing online, unless you go to annualcreditreport.com, what you're seeing at Credit Karma, MyFICO, Experian Boost, etc. They're there for a reason, but they're not representative of what your loan's going to look like as far as decision making. So keep that in mind.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one